That's what our training is on today, how to trade without the use of indicators. Like I was saying, a lot of you are probably used to having a lot of indicators on your chart, and that's the way you've been trained, especially for those who got exposed to forex trading in not so right way. Maybe they just go online and Google how to trade. They follow different people's training. You would have seen that you would have heard about different indicators. You would have probably have a lot of indicators on your chart and believe that you cannot trade without them, that without indicators, you cannot make money in the market. Is that entirely true? Well, is it, and does this also mean that indicator is entirely wrong? That it's entirely wrong to use indicator? No, not at all. The use of indicator in itself is not uh, entirely wrong. It's not wrong at all to use indicators in your trading. It is not like it is wrong to use indicators in your trading. However, it is also not compulsory that you use indicator in your trading, because really the use of indicator in your trading, does it make any difference? Does it really going to do you? Hi, sorry. Hi, Ambrose and Omokudu. Thanks for joining in. So if you have any question, put it in the comment section and let's know where you are joining from. So does it make any difference when you have indicator? Well, for most indicators, they lag. There's something they call lagging. They don't like indicate to you what the market is going to do. They follow the price. Indicators usually follow the price. And I usually tell my students that your highs are the best indicators. I use one indicator, which is moving average, once in a while for my entry. However, even without the indicator, I know when to enter. I just use it for like an additional, thing for me to make entry. It is not compulsory I use it. I do my analysis. I would have determined I want to enter. This is a good buy or this is a good sell for me. Before I decide, okay, now before I enter now, just for an additional indication for me to make my entry into whether to do a buy or sell. And then I use, I had some, just one kind of indicator. I may use different type of it, different length of it, talking about moving average, and that's the only thing. I don't use different indicators. However, I'm not saying that people who use indicators are not, they don't know how to trade. That's not what I'm saying. But basically, indicators do not really make so much difference for you. It doesn't mean that you need to have all the indicators in this life on your trade before you can trade. That's just the truth. Before you can make money in the market, even without any indicator at all, even with your naked chart, you can make money. Why? Because your highs are the best indicators. Most indicators in the market are following the price. If you say you are using, let's say RSI, which was one that I was so dependent on when I had just started trading. You are using RSI, which is strength indicator. You are trying to see the strength of the market. What dictates the strength of a particular currency? It is how fast the price is moving, or what direction the price is moving. So it is still price this is following. So if you can, you're on your own, look at what the market is doing, look at when a particular pattern formed in the past, what usually happens. You will be able to indicate with your own highs. So your highs are the best indicator you can use at any point in time. It is not compulsory you fill your chart with so many indicators before you can trade. So now I'm going to go into the chart and I'll show you how you can trade without indicators. You really do not need to have your charts filled up with indicators before you can trade. A lot of people are fully dependent on indicator. I remember last week or so, or 2 weeks ago, I did a post about indicators, adding more indicators to your charts, whether it is compulsory before you can make your trade or not. Before, and I see a lot of people commenting that they use this indicator, they use that indicator, and some people do not even have any particular trading strategy. Like we have different strategy. I look at what I have on the screen right now. I have been watching this trade because, in fact, I drew this out when it was somewhere like this. This green was forming. On a normal day, what you would expect is for it to continue going up, but based on my Elliott wave, I look at what the market has done, and I felt okay. This is about the fifth wave. So likely we may have some reversal in the market, and that's why I drew this out, and I am still waiting. So if it breaks out to the pink one, then I'll be able to make a decision as to buy. Now, without any indicator at all, I can trade this. Without any indicator at all, I have just drawn rectangle on the screen. Sorry, triangle on the screen. I have two, I call this the double triangle. So I have this on the screen. I know what I look out for here before drawing this. So this, I can totally trade this now without using any indicator. So does it mean I must use indicator before I trade? No, I don't have to use any indicator at all before I trade. This is another one. If you look at what I have here too, this is a swept pattern or head and shoulder pattern, you know. So this can also make me trade without using indicator. I just have pattern. I'm just looking at patterns. So I have noticed that some patterns, when they form in the market will usually buy or they will usually sell. And so I have the patterns like this, down like this, and when they go my direction, I trade them. So let me remove all this and let you know, especially for the purpose of people who are not so old when it comes to forex trading, who are new to trading. So if you look at this chart, this is what a chart looks like. Plain chart. This is a plain chart. I have not added any indicator to this now. So you come into the market, you see this, you see some green colors, you see some red colors. What this indicates is the market is going up when you see more of green like this. But if you look at it in between the green, you still see some small reds, right? It is not like the market is just going up all green. And then you see some small reds too. It isn't like the market is just coming down all red. So this helps you to know what is happening in the market. You see that the direction of the market is moving like this. You say that the market is trending up. You see it's coming down like this, even though there are some green in between, but it's the general direction of the market is a down move. So this is a downtrend. So you want to be able to indicate the trend of the market. You want to be able to indicate your support, your resistance. You can trade very well without any indicator at all. Like I mentioned earlier, for further confirmation, before I enter a trade, I sometimes put moving averages, just for further indication. Without moving average, sometimes I still enter my trade because I have seen it has retraced. I really do not need any other thing for me to know whether to do a buy or to do a sell. So now you have come to your chart, you're seeing this, and you look at it and say, okay, in this area now, this is my resistance. What is a resistance called? A resistance is the ceiling, the ceiling in a chart area, in a particular area of the market. So we are looking at this area now, the whole of this area of the market, starting from somewhere, sometimes around June, starting from June till date. So that is the area I am looking at now. And I say, okay, this area up here is my resistance, which is a ceiling. So this place is like a ceiling. This is where the highest point the market has gotten to. And it got there, it bounces back down, touch it again, then it bounced back down. However, it doesn't mean that this is the only resistant area I can see here. You can also still see some mini ones in between. Because for me, I don't just say, oh, the highest points in the market, that's the only place the market is ever going to get to. So if I look down again, I see another point, somewhere like this, like this area now. I can say, oh, this is another point. If you look at this area, the market hit it somewhere here. It hit it again here. It hit it again here. So these are zones that are like decision zones. The market will likely, if it's going to come up now, you will see that it may not just continue shooting up. It can get here, do a little bit of like, even if it's just a week, it can just leave a week before continuing its way up. So I can say, okay, if I want to do a buy now, I first do buy to this place. Then I take my second profit here, And then I look down and I say, okay, where is my support? A support is the like the floor in the market, like the floor. So I look at this area, I say, okay, where is the floor of this market? And I say, This is the floor right here. Because this is the area where the market ever got to before bouncing back up. And if you look at it, it got here, and then it touches it again. I may decide to put it on the body of the candle, or I just leave it like this. So this area, it touched it at this point, it touched it here. So this may be my support. However, in between, there are also some area like where there are frictions in the market. It wasn't just going down like that, like this area, I can say, okay, it touched this area at the point. I can even look at this one too. This one, this is one area where it got and bounces back up for this area. But even around this area, at the point it got there, bounces back up before going up, and then this one touched it again before coming back down. So these are ways you can just look around the market and you just decide. You've been able to indicate some zones that, okay, if the market comes back here, I'm going to do a buy. If it touches back this place, I either sell, or if it goes above it, I look for a buy maybe up to this point. And then there's also we also call trend line. That one helps you to indicate the direction of the market. So this is what a trend line looks like. So you can say, okay, I put a trend line like this. This market is trending down. And what is a downtrend market? A downtrending market is where you see series of lower highs and lower lows. So in this case, you have a low. This is a high. Then this is a low. This next low is lower than, no, sorry, this high. This is a high. This is like correction in a downtrending market where you see the market coming low like this, then it returns, it retraces. So this is like a correction because the market is generally going down, but then it retraces. So in this case, you see a high here, then it comes down, then you see another high, but that high is not as high as the initial one. Then this low here, this next low that we have here, or let's even say this next low, it's not as high as this. So this new low is lower than this. So you have series of lower lows. So each new low that is happening is lower than the initial one. Each new high that you're seeing, this is another high, it's not as high as this. This is another one. It's not even as high as this. So the market generally is trending down. So in this case, you are still looking at, oh, is this market going to drop? You are trying to look for opportunity for a sell in the market, in a downtrending market. If you want to trade for a long time there, you look out for sell opportunity. However, if you break some major zones, like, this area, rather than it coming down like this, if you break all this area, you start looking for a buy, because that means that it is now moving away from a sell. It has gone above this last high. This was a high in the market. You're expecting this next high to be lower than this, lower than this. All of a sudden, it's higher than this, it's higher than this, it's higher than this. Then that is telling you that the market has changed direction. It's no longer a downtrending market. So this way, you look at this one now. Let's say it pops out of the air. Then you see an opportunity, you do a buy. And you can buy up to this point without any indicator now. This is just a naked chart. So let me go and look for something I have traded before on this particular one and show you what I did there. This is crude oil, and I really like crude oil. It's one has to be careful when trading it though, because it also moves really fast. So you have to be careful when you're trading it. I posted this early in the year, early this year. I think around January or around December. No. It was somewhere here. Then it was around early February because it was here. So I saw this. Let me remove all the lines. Okay, so I look at this. This was a downtrending market. In fact, a strong downtrend market, because if you look at it, it was for a long while, and it really came down. It really came down. It really dropped like that, for a long while. And let's see the number of pips and how many months. Sorry, that's went away. So this was 3,000, about 3,500 pips, 3,455, 3,455 pips. And it took 81 days. 81 days is like less than 3 months, right? So in 3 months, you could actually have doubled your account like three times, or depending on your risk management, maybe like two times. You could have doubled it, like maybe you are trading with $1,000, you would have made it up to like $3,000 at least. You depending on your risk management. If you were a position trader and you have seen all this drop, so in less than 3 months, you probably have moved a trading account of like maybe $1,000 to like $3,000 or $4,000 during this period, during this drawdown like this in the market. Now I saw that one, then I look at this and I say, okay, it looks like we are seeing a change in the direction of the market now. I put in my rectangle pattern, my triangle pattern, and I did this. If you scroll through the group, I think I posted it early in the year. So I look at this like this, and I was like, okay, somewhere, I think it was somewhere like this, something around this area. And would only, in fact, back then I wasn't even using anything moving averages to enter. I just started not too long ago to add moving averages to my entry strategies. So I look at it that way, and truly, it's just my take profit was what it is before it changed direction. So all this I am drawing, I have not used any indicator. They are just lines. They are just drawing tools. So this one, this is my take profit one, this is my take profit two. And look at it. When it broke out of this area, we started trading. When it broke out somewhere, to this second one, we started trading. It take profit one around here, and it hit take profit two around here. Although, because I am not a position trader, I think I took out profit somewhere around there. It came all the way back down. By the time I saw it move up again above my take profit one, I started, when it moved out here around there, I started trading again. I think I took profit somewhere around here again. So this is a good one. Look at this. Crude oil moves a lot. So to that place alone is like 700 pips, to this place. From entry to take profit one is like 300 pips. Then to that place, like 700 pips. That's like 1,000 pips, So this is a great one without indicators. You can trade in different ways. You can identify, oh, this is my resistance, this is my support, as long as it's trading. Some people just trade consolidation. I don't really trade consolidation because I'm not a short-term trader like a scalper. But then some people just like intraday traders, you look at this area and say, okay, this market is consolidating. When it goes up here, you sell. When it comes back down here, you buy. And then you keep buying and selling and buying and selling, and you're making your money for yourself. So it doesn't matter what kind of trader you decide to choose. Like in my training, I have a training on how to identify your kind of trader. It is very important you know who you are. If you're a long-term trader, stick to it. If you can on a natural, your natural kind of person, you can't. You're not a long-term trader. You're fine with just short-term, 5-minute trading, 15-minute trading. However, I wouldn't advise that for anybody because it is more emotional draining. It affects you psychologically. You're watching the chart, and I tell you, the market can be so crazy. You may be expecting it to continue doing sideways moves, and all of a sudden, it just moves out of here and it just keeps going all the way up. And maybe you've even been looking at doing a sell. because it has come to your resistance. Now you want to do a sell. And so you are waiting to do a sell, or you've even entered for a sell because it decided to turn down a little bit. And all of a sudden it jumps and starts going. So the best way to trade the market is trade as a swing trader or a position trader, that will help you a lot. You can leave your trade. Don't even check it. That once you have entered, you know that your risk management game is tight. You've put your stop loss where it should be, and you've known that, okay, even if I lose this trade, I'm not going to lose more than 2 to 3% of my account. So you don't give yourself a headache. You leave the trade, let it go. For one day, you may not even check it. You come back the second day, whether it's going your way or it has hit your stop loss, whatever it does. At the end of the day, you don't judge your trade based on individual trades. You judge your trade based on like 10 trades or even 20 days, or maybe your weekly trades or your monthly trade. At the end of the day, if you know what you are doing in the market, you should be in profit. Even if you lose this particular month, next month you should be in better profit. So we don't want to approach trading with the mindset of a gambler, because it is only a gambler who will come into that in this market. And within this is by the way, I analyze with 4 hours most of the time. So I'm on 4 hours time frame. So I don't bother myself sitting in front of the computer after entry. Why? Because I know that for each of these candles to form, it takes 4 hours. This candle you are looking, so this tiny candle you have seen, it took 4 hours. Whereas somebody is on 15-minute time frame. Let me go to 15-minute time frame. And is struggling. Look at what has happened. Consolidation in the market. The market is just moving. Look at it. Somebody is trying to buy. He buys here. Before you know it, another sell enters, another red candle. And so you're doing all this. You're going to have a lot of headache trying to do this. Look at how tiny these candles are. Very tiny. But if you sit on, you know that I won't check it for the next 4 hours. Rather than coming to check it every 15 minutes, you're trying to talk to your spouse. You cannot concentrate. Your children are asking you questions. You are screaming at them. I used to be there. In fact, I will be driving. I will be checking my charts. That is not the best way to drive, to trade. The best way to trade is you understand what they are doing. Trade the bigger time frame. Come to 4 hours time frame. Come to at least 1 hour time frame. Come to daily time frame. Trade the right way. It will help you know what the direction of the market is actually doing. Not for you to be on 1 minute, 5 minute chart and you are trying to look at what is happening. You are giving yourself unnecessary headache. So if you're on 4 hours time frame, a candle forms, you know, okay, this candle is still not indicating what I want to do in the market. You leave it, you come back in the next 4 hours, or even come back after 12 hours or 24 hours and check what is happening. You've taken your trades, you're on your own, waiting for what is going to happen in the market. So this is a naked chart. You really do not need all the indicators. You really do not, because what are indicators for? They follow the price. Your eyes are the best indicators. You are looking at this place and you see that this is dropping. RSI is also going to be showing you weakness. It's going to be showing you that you maybe, okay, let's look at a pair that you can easily understand which pair is strong, which pair is weak. So now let's look at this one. This is moving up. Generally, there are some red candles in between. This is USD card. So you're looking at this place. It's going up, it's going up, it's going up. RSI is also increasing. Why? Because the price is increasing. And you're giving yourself a headache and using RSI to judge. Why not look at the price yourself with your eyes and make decision? The market is not, it's not that crazy. People who are able to define the indicators, they are humans like us who just feel, okay, let us look for simple ways of so that we will not start burdening ourselves and looking at indicators. There are people that are good with coding. They decide to code something out and then they call them different indicators. I am not saying it is bad. In a way, if you want to have different ways of looking at the market, you may use the indicators. They help you see, okay, this particular currency is strong, this is weak, but you yourself can see it. Each of these currencies, for instance, USD on its own, you can come to DXY and say, oh, is USD strong? Oh, USD, now look at me, look at what I did. I put this line here above this consolidation. I say, okay, if it breaks out of here, it means that USD is about to be strong. So this one tells me that USD looks like it is looking strong now. I look at Canadian dollar and I say, okay, USD and Canadian dollar are in the same zone. If USD is becoming strong, that means that Canadian dollar is likely going to be weak. And so now it is still consolidating. I'm going to wait and see what is going to happen. If it breaks below this, my trend line here, that means that Canadian dollar is one that is still strong. But if it goes up, because this is USD card, so USD is the base currency here. If it goes up, then that means that USD is truly strong, like I can see in the DXY. DXY is just this one, you can't trade this one. It's just indicating the strength and weakness of the currency, of this particular currency, which is US dollar. And all the other currency too, you can check them out on TradingView. You can go to just you check out only Canadian dollar, check out only Australian dollar, check out only euro, and see the strength without having to put any indicator. I have a training, part of our training, I have currency correlation training. With currency correlation training, you are going to be able to say, okay, this currency is weaker than this particular one is stronger than this, and that can help you to combine what currency to trade. I want to trade USD CAD, I want to trade GBP USD, I want to trade this one, I want to trade that one. By understanding or looking at the strength and weakness with your own eyes, people without using any indicator, you will be able to trade it. So you really do not need all the indicators before you can trade. However, does that mean you shouldn't use any indicator at all? You can still use indicator. I use moving averages, for instance, for my entry, just basically the entry. I don't really look at it until I have defined that this is buying or this is selling. And how do I define that this is buying or this is selling? I look to my charts. I look to my chart myself and I say, okay, this is now selling, or oh, this is now buying. You know, so let's look at USD. USD, Euro USD. This is Euro USD. Look at all this. Look at this, for instance. I was using this to do a training on head and shoulder a few days back, and I said there's a small head and shoulder pattern here. You know, there's also a bigger one here. Head and shoulder pattern. You see a high, you see a higher high, you see. So there are patterns in the market. Some people use harmonic patterns. You are going to be able to identify that, okay, this is a W, this is a hem. And because of that, you expect a buy or you expect a sell. So people are trading just patterns in the market and they are making a whole lot of money without using indicator. Just looking at, oh, how is the market moving? And they are trading. I use different patterns. I use my quarters rectangle, different rectangle pattern. I trade consolidation, not inside the consolidation, but when it breaks out of one area to the other. You know, so without using any indicator, you can trade. However, you can also say, okay, just for me to determine at what point exactly I want to enter, I want to put moving averages. I want it to have crossed this particular moving average or to have crossed that particular moving average. Then I will trade it. So do you really, is it compulsory that you have indicators on your chart? It is not compulsory at all. They are unnecessary distractions, really. They are unnecessary distractions. Most of the time, I don't even remember to put my moving averages before I know that, yes, this is, I'm ready to do an entry here, or I'm ready to do to do a buy here, or I'm ready to do a sell here. So you can truly trade the chart nakedly like this without indicators. Now, what do I mean by indicators? There are different indicators. If you come up here, this is indicators. If you click on it, there are so many indicators that you can see. Look at them. Accumulation, distribution, advance, decline. There are so many I've never even seen before. If you keep going down, you are going to see so many of them. So many, Bollinger Band and all of them. And how many do you want to trade? So the best way you trade the market is look out for, if you really want to just use maybe one part, one indicator or two indicators, look out for something that works with your own strategy. You know, that is supporting. Maybe you are just someone that trades resistance and support. You just want to use a simple indicator that tells you that yes, this thing has truly broken above this area, or this thing has the volume is actually high at this point. So you can use volume. Some people use volume. It helps them to know, okay, this currency has more volume than this one, because sometimes the market is just faking you. So you use this indicator. This one tells us the volume of the market, it can also be deceiving. You know, look at this green now. See the way it's shooting up. Just because there's a little shoot up there, all of a sudden, see how it dropped down. It just drops down. So if you are looking at this and because of this shoot pin in the market, you also quickly jump in and decide to do a buy. Guess what happens? You are going to make loss here. So look at this now. This is volume. This indicator I put down here. See what this does for us. See this green volume. See how it shoot up like this. You know why? Because of this one. This just one candle like this. That is going up. That's why this. Now, if you have depended on this thing for you to make a decision, you know what you're going to do. Immediately this candle forms, you will quickly jump into a buy and start buying. But guess what happens? The market drops and the market is selling. So this can deceive you. But if it is me, rather than using this indicator, I'm not looking at this indicator. You are trading, you are looking at volume indicator, and you are using that to decide whether you want to do a buy or sell. I am looking at my market, a naked chart, and I said, oh, I just set even ordinary trend line. I put it up here, and I say, okay, as long as this thing is below my trend line, that means that it is still a downtrending market, and I'm not going to look out for a buy in a downtrending market. So I'm not going to buy because the market is trending down. I rather keep looking out for a sell until the market turns and start going my way. That's broken above the trend line, and I've put in some other buy strategy, and I say, okay, this thing looks like a buy. Maybe I see my sweat pattern there. Maybe I use my snapper strategy or use any of my strategies, and I say, okay, this thing truly looks like a buy. Then I will go in for a buy. But as long as it doesn't show me an indication to do a sell based on to do a buy based on my own strategy that has to do with naked chart, I'm not going to buy. But if you have been dependent on indicators, look at how volume is deceiving you. Maybe just some rich people just put in money and just buy some, so the volume shoot up immediately. All of a sudden, it keeps dropping. It continues dropping. So if you had bought at this time, you would have been losing. The market would continue its way down, but you are waiting and praying and begging God that, oh God, let this continue its way up so that I will be, so that I will make my profit on this buy and I will not lose. But definitely you probably have lost because maybe your stop loss is going to be below this last low. And so by the time it gets here, you would have lost that trade. So that is why naked chart is not a bad one. Your eyes is telling you that this thing is still going down, it's still trending down. So your brain will already tell you, I'm not going to do a buy. But indicator is telling you another thing. Do a buy. This is volume. Do a buy. The market is it's shooting up. So rather than giving yourself unnecessary, deciding on whether to buy or sell based on indicator or focusing your strategy on indicators, I would advise you focus your strategy on the naked chart itself. Whether you want to use geometrical pattern analysis, you want to use technical analysis, just use your own analysis. Whatever strategy you want to use, have your strategy in place that will already indicate what direction the market wants to take for you. Then you can now decide, okay, for me to enter as an entry strategy, I want to put this indicator. There are different indicators too for entry that people use, that I have used in the past, that are also not so bad. So you can use those indicators for you to determine, oh, I want to enter now, I want to exit now. Entry and exit strategies, indicators are not bad for them. But for you to make your decision, for you to have your own real strategy for entry, for determining that, okay, this direction is a buy, oh, this is a sell, then I tell you, you need to have your own strategy. So that's basically that. Does anybody have question about what we have discussed about trading this afternoon, about trading the naked chart? So when I say naked chart, this is what I mean. So let me remove the volume. This is what I mean. Let me remove all of this. This is what a naked chart looks like. However, it is still not indicator when you use a trend line, when you use any drawing tool that you can see from this side. It's still not an indicator when you use all this. This is still not an indicator. You're just using your drawing tools. Does it also mean that I'm condemning indicators entirely? No, I'm not condemning indicators. I am only saying that its focus is very important in trading. So if you really want to focus, you want to have a strategy and focus on it, then focus on your strategy rather than getting one indicator. Oh, somebody says this indicator is good. Oh, if you use this indicator, you're going to make a lot of money. You quickly download that one. Oh, use this indicator, you download that one. You will see that you are getting distracted. You are having too much indicators on your chart, having too many strategies at the same time, it distracts you from the market. So what you want to do is, for me, if you attend my course, you're going to see me teaching different strategies. That does not mean you need to trade all of them. You can trade just one strategy and be profitable. So you want to test, even if you know more than one strategy, you want to test your strategy with your favorite currency pair. Is it working with it? If your strategy is working with your favorite currency pair, then you continue trading that strategy with that pair. If it's working with, maybe you have 3 or 4 currency pairs that you love to trade, and one particular strategy works for them, then just focus on that strategy and trade that. You don't have to trade like 10 strategies to win in this market. So that's basically that. If you have any question at all about trading naked charts, please let me know. And if you would like to join our Forex Varsity course, it's still open for the promo price. You can still be a part of this. And Forex Varsity, to go there, you just go to Money Sellers Africa Forex Academy /Forex Varsity, and you are going to see the breakdown of the courses that you take. You see the breakdown of the courses, and you can also check the academy itself from there. You see, this is it, the basic level. We have basic 1 to 6 with different lessons under them. Basic on the intermediate level has three courses with different lessons under them. Then the advanced level has a lot of courses. Now, for each of these courses on the advanced level, if I'm selling each of them normally, one by one, I would have sold $100. If you look at my triangle course, it is $100 to sell it. So if you are getting all of this at just this further discount of 50K, it is worth it. It is really worth it. Then you can go to the academy and see the training. If you come to down here, just click your academy. You can view the academy and see what is happening in the academy there. It helps you to see how many minutes is assigned to each training. Just scroll down. You are going to see them. So this is it. Basic Forex 1, 43 minutes. This one for the 8 minutes. It has different lessons under them. It's going to see, if you are already registered, if you click on this, it's going to take you straight into the course. And each time as you watch each of them, you complete it, you move on to the next one, and you click on complete and continue. You watch each one. So that's how the courses are. So when you are done with this one, you click complete and continue. Then the same way, you just move on and get to, you cover the academy. Now, aside from all this, aside from and interestingly, all these courses here, they're going to have lifetime access to them. Now, aside that, you also have 8 interactive live sessions where I come up live. You can ask your questions, and we do this together. I help you to further understand what you're learning here. That's live interactive session will take between 4 to 5 weeks. However, this one is lifetime access. So you're going to have to your academy here on Teachable. That's where the academy is. So you have lifetime access to that. So that is it. Thank you so very much. If you still want to register, we welcome you to register to be part of us, to be part of this September class. So thank you. And if you have any question, you can reach out to me in the comment section. I'll be more than ready to give you answers. Thank you and have a beautiful day.